appreciate hearing your comments on publicly held companies using their cash for dividends versus stock buybacks.
Well, the equation is pretty simple, but the practice doesn't necessarily follow logic. It's obviously, as long as you're telling the truth to your shareholders about what's going on so that you aren't manipulating the stock downward or something, when a stock can be bought well below its business value, that probably is the best use of cash. It's something the Washington Post did on a huge scale back in the 1970s. Teledyne may have bought 90% or something or close to it of their stock back. And that was the reason a very significant percentage of companies bought stock back in the past because they actually thought it was selling for less than it was worth. Like I say, that can be abused if you do various things to bury your stock in one way or another. But that wasn't the usual case. Stock repurchases were relatively unpopular in those days. They've become quite popular now, and to the extent that I've been around a good number of them and been able to pick up on what I thought was the underlying rationale, if not the professed rationale, I think it's often done for people that are hoping that it causes their stock price not to go down, and often done at prices that don't really make a lot of sense for continuing shareholders. If we wanted to return a bunch of cash to shareholders, if our stock was undervalued, we would go to the shareholders and say we think it's cheap and we think that this cash can be better used by you than by us, and we will therefore be repurchasing at what we think is a discount to intrinsic value, and the people that remain will be better off, and the people that get out will get out at a little bit better price than they would otherwise. In terms of dividends, you get into an expectational situation. And for most companies that pay a cash dividend, it doesn't make sense to bounce around the dividend from year to year, although private companies frequently do that. And we do it ourselves with our subsidiaries. Some subsidiary can pay us a lot of money one year and not so much money the next year. But with public companies, a lot of people do buy stocks to obtain dividends, and they hope for regularity, and there's a signaling aspect to it and everything. So I would say that once you establish a dividend policy with a public company, you should think a long time before you change that policy in a material way. But I think the best use of cash, if you don't have a good use for it in the business, if the stock is underpriced, is to repurchase it, and if it's overpriced, you got no business buying in a single share. But a lot of companies do it. Charlie?
Yeah, dividends are a very interesting subject. If you count the unnecessary stock trading and the cost of investment advice and the cost of making a lot of errors and the trading costs in and out, I don't think it would be too extreme to say that now the total amount that's paid out in dividends is roughly equal to the amount that is wasted in all this trading and investment advice. So that the net dividends that come to the shareholders are approximately zero. This is a very peculiar way to run a republic, and very few people comment about it.
Yeah, actually I did in an article some time ago in Fortune. The frictional costs to American shareholders in sort of changing shares for all American business as a whole, those frictional costs are probably not much different than the entire amount paid out by American corporations. But getting to the individual corporation level, a company that expects to regularly earn more than it can profitably employ in its business should be paying out dividends. Take a subsidiary of ours like See's Candy. We would love to expand See's Candy to double or triple its present size, but it doesn't work. We've tried it a lot of different ways. So it should be paying out its earnings. If it was a public company, and it was at one time, you could argue that something approaching a 100% payout would make sense there. But most management's worrying about earnings falling off at some time in the future would rather establish a lower level and therefore ensure regularity of dividends by going with with a conservative level. It's obviously something we think about at Berkshire when we have $30-odd billion around. If we can't figure out a way to employ that over time, it's a mistake to keep it in corporate form. But we have this expectation, and I think it's a reasonable expectation, that we get to put it to work. If we ever came to the different conclusion, if we thought our stock was significantly undervalued, we'd probably figure in terms of dispersing it through repurchases, particularly where now dividends and capital gains are neutral for individuals. If our stock was not underpriced and we fell, we would probably do something via a dividend. It's not going to happen soon, however. Number 8.
Good afternoon, Mr. Buffett, Mr. Munger. My name is Mark Stender from San Francisco. My question involves, if you live in California, which I understand you do some time of the year, it's almost mandatory that you shop at Whole Foods markets. They sell a lot of organic food there, and I was wondering if anyone ever tried to feed you organic food or organic food stock.
I've never been near the place, but Charlie, who I've never thought of as a health nut, but he may have some comment to make on this being a Californian.
No, my idea of a good place to shop is Costco. Costco has these heavily marbled fillet steaks in the finest grade, and the idea of eating a little whole grain whatever or washing it down with some carrot juice has just never appealed to me.
We don't have a lot of arguments between the two of us about where to eat. Number 9.
Good afternoon. My name is Andy Peak, and I'm from Weston, Connecticut. As a keen China watcher, I was very interested in your PetroChina investment. Could you please tell us more about your thought process on investing in a complicated, opaque country like China and PetroChina?
Yeah, PetroChina itself is not a complicated or opaque company. The country, has obviously different characteristics in many respects than the United States. But the company is very similar to big oil companies in the world. PetroChina may have been the fourth most profitable oil company in the world last year. I may be wrong on that, but they produce 80 or 85% as much crude daily as Exxon does, as I remember, and it's a big company, and it's not complicated. I mean, obviously a company with 500,000 employees and all of that, but a big integrated oil company. It's fairly easy to get your mind around the economic characteristics that will exist in the business. And in terms of being opaque, actually their annual report may well tell you more about that business, than you will find from reading the reports of other oil giants. And they do one thing that I particularly like, which other oil companies don't, at least to my knowledge, is that they tell you they will pay out X percent. I think it's 45% of their earnings, absent some change in policy. But I like the idea of knowing in a big enterprise like that 45% of what they earn is going to come to Berkshire, and the remainder will be plowed back. It was bought not because it was in China. It was bought simply because it was very, very cheap in relation to earnings, in relation to reserves, in relation to daily oil production, in relation to refining capacity, whatever metric you want to use. It was far cheaper than Exxon or BP or Shell or companies like that. Now you can say it should be cheaper because you don't know what will happen with it 90% owned by the government of China. And that's obviously a factor that you stick in valuation. But I did not think that was a factor that accounted for the huge differential in the price at which it could be bought. And so far it looks okay on that basis. we aren't there because it's China, but we're not avoiding it because it's China either. We stick in a fairly appropriate number. But if you read the annual report of PetroChina, I think that you will have as good an understanding of the company as you would if you read the annual report of any of the other big oil majors. And then you would factor in your own thinking about whether there could be some huge disruption in Chinese-American relationships or something of the sort, where you would lose for reasons other than what happened in terms of world oil prices and that sort of thing. But we're happy with it. And Charlie?
I've got nothing to add. If a thing is cheap enough, obviously you can afford a little more country risk or regulatory risk or whatever. This is not complicated.
Yeah, Yukos, as you know, is a very big Russian oil company. And in evaluating Russia versus China in terms of country risk, you can make your own judgments. But in our view, something like PetroChina was both cheaper and had less risk. But other people might see that differently. We'll go to number 12.